Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending August 25th, 2023. Appreciate you all tuning into this channel, liking and subscribing, and that does help in the algorithm. So thank you for that. And today I'm going to title my video, The Nvidia Blowoff Top and Jackson Hole Speech Creates Market Whirlwind. And I did use, just in the spirit of things, I actually used ChatGPT to try to help with a title. I didn't use any of the exact suggestions, but I certainly helped. It's kind of top of mind. Interesting little prep for this video. But this week was really all about Jackson Hole. There wasn't a whole lot of economic data. You'll see that here. Existing home sales continue to decelerate. Record low number of inventory, and that's really driving that. And single family home sales continue to grind higher. So you can see we hit a low back in the summer of last year, and this just continues to grind up, and that's really, this is all about low inventory in the existing home market, and the home builders are doing just fine. On the underlying economic front, you have new orders, excluding defense, that was down 5% month over month. So it gave back pretty much all the gains from last month. And that was very interesting. Big move down. What does that mean? Is that a one-off event? Is that a trend? But durable goods are very important to the overall economy. Those are things that last over a year, typically big ticket items. So I thought that was interesting. The Kansas City Fed Manufacturing Production Index, that actually had a good month after 4 months in a row in negative territory at the 12. So anything above zero is obviously growth. So that could just be a snapback, though, from basically 4 quarters or 4 months in a row negative. Let's see, if you go all the way back, you're talking about, what's this, 5? So 9 of the last 10 months have been negative for this indicator, but that's just the Kansas City Fed. Okay. Consumer sentiment, that ticked down a bit, but really not a whole lot of news there. And let's move over to the Fed meeting that's coming up less than a month now. So, maybe not talking about it soon, but it will be on the docket for the market to be talking about. And the Jackson Hole speech that was this morning, was the expectation was that this was going to drive the expectations for rate hikes in the future, one way or the other, and it really didn't. Right? Yesterday we were at 81%, and now we're at 80.5 for a pause. No real change. In November, we did see a 50% go from 50% chance of a pause to 40% chance. So we did get a little bit of a tick up on a potential rate hike in November, but November is a far ways away. You still have all of September, all of October, the rest of August, and there's a lot of economic data to see exactly whether or not that's going to come to fruition. But interesting to see that little bit of shift in markets. December, same kind of move here, right? So the market is kind of on a 50-50 now that there will be one more rate hike this year. So that means the speech, or the way that it was interpreted by markets this morning, was a little bit hawkish. You saw that in the ultimate reaction to that news, and you can see that here. This is the SPY on this morning, but we rallied the rest of the day and ended up decently. So something to consider, but obviously, that's a big question, is how will those expectations evolve? Now, I do want to cover Nvidia. Nvidia had earnings after the bell on Thursday, and or was it before the bell? Or maybe it was after the bell on Wednesday. There we go. The reaction was on Thursday, yesterday, and we had a big rally higher. We opened very high, I think even after hours. If we go to a 5-minute chart here, you can see this went as high as 520. Okay, we opened right around 503 or so. What's that high? What's that open? 502 and change. So if you were smart enough to short it in after hours, you had a pretty big gain so far, because we're all the way down to 460. And this is on high volume. Even today was pretty high volume on a down day. And this looks like a capitulation top, or a blow-off top, shall we say. So something to be watching for, and how will that lead the broader market and especially the tech space. So if we look at like the SMH, the largest holding is Nvidia, and that had that bearish engulfing candle. Then we had a pause today. We had a follow through with Nvidia, a pause with the SMH, and we'll see what we get into next week before the holiday shortened week, the week after that. Now, this is the IW after the Von V again. This is growth to value. We had a little bit of rally earlier in this week. We had that reversal on Thursday and a pause today. This MACD is not looking very good. So this looks like it's trying to roll over, and obviously that would lead the market downward. Let's take a look at the broader equity markets, the NYSE, that continues to find support here right around that 100-day moving average, right around that 382 retrace. So not a shock there. The SPX, that is doing the same thing, getting a little bit of a bounce, had that reversal candle on Thursday. So, do we get a follow through? It's you want to see a follow through to those big reversal candles to give you some indication that that wasn't just a one-off event. And you can see that with the Qs as well, very similar pattern, obviously a lot of overlap in positioning there. And let's see, what else do I want to go to? Let's check in on the bond market. And we always say if there's not a credit event, it's hard for markets to really get a lot of traction to the downside. And this is not rolling over, right? Found support at that 100-day moving average and continues to bounce from there and closing at the high of the week. So credit markets are certainly holding in just fine, which gives room for the Fed to continue to keep rates elevated and maybe raise rates one more time this year. We shall see. Now, the 10-year did pull back this week from over 4.3 at the close last week. Now we're at 4, call it 4.25. So a modest pullback, but still in that broader uptrend. The MACD did cross here, so that could mean something. You get a little micro bearish pattern here with that Wednesday move down and then 2 days consolidation. Would not shock me to see rates move down again next week. Let's take a look at the MOVE index. Here is the MOVE index, and it goes lower. You're at 110. This is the volatility of the bond market, and there's no problems there. So it's hard to see broader problems in the market. The VIX, that did pull back today, up yesterday, just still kind of in this meandering sub 20 level. Anything sub 20 is still relatively bullish for markets. That's not a whole lot of volatility. Let's look at oil. Oil had a nice bounce today, so that certainly helped the energy part of the market. Here's the XLE, and that's looking like it's continuing its uptrend. Here's the OIH, oil services, also looking relatively bullish overall. And let's look at commodities. I've said this, the commodities are starting this new uptrend here in the face of a strong dollar. And look at this, look at a nice move up this week, just constructive pullback over the past month or so. And that's, once again, in the face of, look at the dollar. So how are commodities getting such strength even with the dollar so strong? You have to be asking yourself those questions. And that's the question I'm asking. And it shows you just that underlying strength in that commodity space. Let's look at, let's look at silver and gold. Silver to gold ratio. I talked about this wedge pattern last week, how we had this downtrend line and now an uptrend line, and it was going to meet and break out one way or the other. This broke out this week to the upside, silver to gold ratio. That tends to be good for the precious metal market, and that had a nice bounce and consolidation, a big bounce on Wednesday on that pullback in rates. And that's what's making me say I think rates are going to pull back soon. And gold is kind of sniffing that out. You're getting a little bit of a micro bullish pattern as well on that, the inverse of that micro bearish pattern on the 10-year rate. So it would not shock me to see this head higher, especially if you see a follow through in that silver to gold ratio, which definitely broke out this week. Let's look at some of the more cyclical parts of the market. Industrials held up just fine. Let's look at consumer staples. Consumer staples look how weak consumer staples look. Look at XLY to the XLP. I mean, this is consumer discretionary to consumer staples. Typically, when there's a big risk-off event, money flows into consumer staples out of discretionary. And so far, that's not really happening. There's still some relative weakness in the XLP and obviously XLY getting a little bit of weakness, but certainly XLP is much weaker. Let's look at ARC to the Qs. And that continues to be weak as well. So money continues to flow out of the marginal parts of the market. And you can see with Bitcoin, it didn't really get much traction this week, just consolidated sideways at the 100-day moving average. I think Bitcoin's going lower as well. And this is usually a canary in the coal mine to the broader tech sector. So, as I've been saying, I think the back half of this year is going to be much more volatile. You've already seen that. Doesn't mean that we can't have up moves. This could just be the pullback and we get a rally to those highs in July and then more of a choppy period. That is certainly possible to get. If you zoom out here on the S&P, we've rallied pretty nicely since the fall lows, and we were overbought. Look at the MACD, look at RSI, look at the Williams %R. All these were in overbought territory into resistance. This high from April of last year, and that's major resistance. That's where the market tried to pull back, very similar to what it's doing now, right? Pull back over a couple months, rallied and failed. Okay, and the big question is, do we get that? Do we get a pullback for a month or two, rally and fail? Or do we get a choppy period to get through these levels, which are definitely resistance, and we break out next year? I think that, or in the fall, or in the winter, excuse me. I think that's certainly possible as well. We'll know a lot as I think economic data comes in. If inflation continues to kind of ebb and we don't see more rate hikes, I think that could mean a breakout to the upside. But right now we're into resistance. We're getting a healthy pullback. This has been a very healthy pullback. Nothing to write home about. You can't really call this a major bearish breakdown. This is just pulling back to roughly the 100-day moving average. Zoom out to the NYSE, kind of same thing, right? So overall, you still have to be modestly bullish. We're getting closer to, I said, if we're going to break down, it's probably going to happen in the next 2 weeks now. Last week I said in the next probably 3 weeks. So we're a week in and we haven't broken down. So we still have a couple more weeks and we'll see if the liquidity dynamics within the market are drying up. But if you look at the MOVE index, it's not really showing that. So there aren't a whole lot of signs. Credit's not blowing out. MOVE index isn't causing a problem. The VIX remains relatively muted. The dollar strength is something that you could say is a signal of drying up liquidity. That's a potential. But overall, you have to still be modestly bullish. So I thank you all for tuning in to this channel. I want to remind you that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.